How's it going today? Everybody have a good weekend? Parker, did you have a good weekend?
Yeah, it's fun.
Yeah. So anybody who doesn't know, Parker scored the go-ahead touchdown that won the game on Saturday. So Parker, you're excused from the exam. Wouldn't that be great? Wouldn't that be, you're gonna actually have to earn your wins in the classroom outside the classroom. But I actually have a story. I used to work as an academic tutor at OU when I was in the master's program, University of Oklahoma, who at the time was a perennial national championship contender. And I'll tell you a more full story about my experiences, but suffice to say, our football players are a lot smarter than their football players. All right. So guess what? We got exam one coming up on Wednesday. So we got to prepare for that. So let's go ahead and talk a little bit about what you need to prepare for. So quick debrief before we go through this study guide. I strongly recommend that you bring a pencil and an eraser. You can do it in pen, but if you make a mistake, which can happen, or if you want to change your answer, it's just much easier to correct it if you use a pencil and eraser. They're always so excited in that class over there. I don't know what's going on? Gracious. Also, just for context, bring a calculator just to have one. I think the calculations that I'm going to ask you are going to be very simple and you probably can do them by hand, but why waste the time? Just bring a calculator. Actually, bring two calculators. Bring your good calculator and bring one of those junk calculators you get as a gift from potential recruiters. That way, if somebody has a calculator outage, like the battery goes down, you can be a hero and you can give them your extra calculator. So has it happened before? Yes. And you always feel like you've done something good for the day. As far as the breakdown for the exam, there are 12 multiple choice questions and there are, I don't recall in the exam itself. I think there's one or two problems. Regardless, it's going to be multiple parts for each problem. The breakdown of multiple choice questions, there is one question on chapter one question on chapter 2, 4 questions on chapter 3, and then 3 questions each on chapters 4 and 5. The problem is going to be all of the chapters, but it's going to focus very heavily on the chapter 4 and 5 content. Okay, so it will involve all chapters, but we'll focus heavily on 4 and 5. All right, so let's go ahead and go through this. Like I said, I am not going to go through every point of the study guide. The stuff that I am going to cover, I'm going to cover very, very quickly. If I mention it, it's almost certainly going to be something that's I consider very relevant to the exam. That does not mean that if I don't mention something, it will not be on the exam. The entire study guide is live. If it's on these sheets of paper or these virtual sheets of paper, I guess I should say, then that's something you should be prepared to answer. If you have a question about something that I do not cover, feel free to raise your hand, or if you need more explanation, I'm happy to talk about it. All right. First of all, principal-agent relationship is a foundation for audits. And so principal-agent relationship is characterized by something called information asymmetry. Does everybody remember information asymmetry in that concept? It's that the principal has less information than the agent because the agent runs the business on a day-to-day basis. So they can actually kind of confuse, or not confuse, they can hide what the true position of the organization is and have in the past. So the goal of the auditor, goodness gracious. Dr. Ramirez's class. I've never heard anybody that excited for his classes before. That's right, Musa. I said no one gets excited for your classes. Yeah. Come watch me on YouTube. All right. Anyway, so we talk about principal agents. The agents have more information than the principals, and so principals hire the auditors in order to make sure that they get all the necessary information they have to make a decision. All right, so I'm going to talk about these again, but it's important to note that you need to know management assertions. You need to know them. When I say know something, that's not memorize the names. Okay, if you memorize the names, you're about 20% of the way there. You need to know these. You need to understand how the context that they're used and how they relate to all the other stuff that we talked about over the course of these chapters. The assertions are, in my opinion, the most important content for this entire course. So you need to know them backwards, forwards, front, and back. And obviously that I'm being facetious when I say that. You just need to know them really well, understand them in context. What are the assertions that relate to transactions and events? That's every single one of them except for rights and obligations. Rights and obligations is a count balance assertion only. What are the assertions that are about that relate to account balances a period in? That's all of them except for cutoff. And if you count it as assertion, authorization. Okay. It's unlikely that I'm going to ask a question about the assertion of authorization, but like I said, I included on there just to be consistent. 4 types of audit reports. So remember the types of audit reports. We talked about these briefly at the end of the chapter. We're going to talk about these a lot more depth for the second exam. I'm going to go into a lot more detail. But for context, what I do expect you to know is the name of all these reports and what they represent. So an unqualified report is basically everything is good. It's called a clean opinion. All right, it represents a clean opinion. So anybody remember the term that the ASB uses for this? It's not unqualified, it's something else. Modified, very good. All right, and then we have qualified, which basically says everything's fine except for 1 or 2 material issues. Okay, this can come up if there's a departure from GAAP or if there's a scope limitation. So departure from GAAP is that the company is not following the rules, the client's not following the rules of financial reporting. Scope limitation basically means that we can't determine what the problem is. We weren't able to test it. That's material. Okay. Now, if we have pervasive issues, that's where we have our extreme opinions. Adverse is it comes up in the situation where we have a pervasive departure from GAAP. And a disclaimer opinion comes up when we have a pervasive scope limitation. All right. So make sure you understand the differences between all those. I'm not going to ask you detailed questions on those, but like the exam, I may ask you high-level questions about these. All right. Make sure you understand the major phases of the audit. Probably more importantly, whenever I ask a question, be sure you understand what phase of the audit you're in for certain questions. There are a lot of types of questions that are going to ask you to understand what phase of the audit are you operating in currently. This comes up most frequently during planning phase questions, but can happen during any phase of the audit. So make sure you understand the phases. For context, there's a little bit of a differentiation. So for the general phase of the audit, we got planning, risk assessment, test of controls, substantive procedures, audit closure, audit report issuance. Okay. That is differentiated by the phases in audit testing, which is risk assessment, test of controls, and substantive procedures. All right. Remember, substantive procedures has 2 sub phases as well. It's got analytical procedures and test of details, which we'll go over in a little bit. Chapter 2, there's not much to chapter 2. Please make sure you take a look at the slides that talk about these concepts of due professional care, professional skepticism, and most importantly, reasonable assurance. Those are all concepts that are central to an auditor's responsibility and what they have to do. Also, make sure you look at the slide that talked about ethics, professionalism, and the professional code of professional conduct. We're actually going to go into the code of professional conduct after the second exam, but it's probably good to make sure you have understanding of what its general purpose is right now. All right. So moving on, chapter 3, client continuance. Okay, so we talked a little bit about some reasons why an auditor may say, I've done your audit in the past, I'm not going to do it moving forward. There were 2 basic reasons. One is going to be basically a contentious relationship with a client. That's basically where a client creates all these problems and you're just like, I'm done, I have enough, I'm not going to deal with it. The other is going to be a disputes over audit fees. If their client's not willing to pay us enough to do the job, then we're not going to do the work. Now, keep in mind, this is different from changing auditors on a client request. A client may actually hire a new auditor because they need it for a certain reason. That is not necessarily contentious. A client just may say, I need a larger auditor to handle our growth in business. Okay. That is not one of the reasons. The reasons that we're assuming here are basically auditors' decisions to walk away. Okay. The primary sections of the engagement letter. We talked a little bit about these. There are 3 primary sections that should be in every engagement letter. Okay. Those are going to be management's responsibility, auditor's responsibility, and the objectives and scope of the audit. Management's responsibility, auditor's responsibility, and the objective and scopes of the audit. Now, real quick, okay, is there a difference between management's responsibility and auditor's responsibility in general? Yes. Which one's responsible for the preparation and presentation of financial statements? Management. Who's responsible for the design and implementation and maintenance of internal controls? It's also management, okay? What is auditor's responsibility? It's for testing these items, okay? Making sure that financial statements are free from material misstatement and the controls are designed and operating effectively, okay? So management's responsible for the creation and maintenance of this. Auditors are responsible for testing these items, for gaining assurance about these. All right. There was a slide. It was slide 11 in the first set of chapter 3 slides. So remember, there were 2 different sets of chapter 3 slides. So the chapter 3 slides, first slide set, slide number 11 dealt with all of the components of the audit strategy and plan, I would review that slide just to make sure you have an understanding of what are some important things that occur during the strategy and planning of an audit. When we talk about related parties, there's this concept at arm's length. What does that mean? So the vernacular is if something occurs at arm's length that it's far enough for a handshake. Okay, related parties, are they closer or further than arm's length transactions? Closer, okay. It's remember the idiom is like if somebody gives you a hug, then they're closer than a related party. Okay, or they're closer than a non-related party. They're a related party if they give you hugs, they know you well. Auditor has responsibility for related party transaction. Primary responsibility is to make sure all related party transactions at a client are disclosed in the financial statements. Secondary responsibility to make sure that the related party transactions are indicative of arm's length transactions. Okay. So what that means is that even though they're not arm's length transactions, they should be consistent with other transactions that are similar to it. So say for example, I'm the landlord in this particular area, okay, and I'm charging every single one of you $500 in rent, but my nieces show up and I charge them $200 in rent. Okay, that's probably something that people do in the real world, as they charge a little cost because I'm bearing that cost before. But an organization, that would be forbidden. Okay, you shouldn't be forbidden. I shouldn't say that. It's a bad idea. It's not forbidden. Related party transactions are not forbidden. It is forbidden to conduct those transactions without full transparency, is what I meant to say. Okay, so these transactions do need to be transparent and they need to be disclosed. So the auditors are responsible for doing that. Phases in audit testing. Remember, we talked about this. This is really important. Make sure you remember all the phases in audit testing: risk assessment, test of controls, substantive procedures, and the sub-steps and the sub-stages to substantive procedures. We're going to come back to these because remember, certain types of evidence can only be collected during certain phases. Okay, so we're going to talk about that. In applying materiality in audit, I would strongly recommend that you go back and review the Wilson-Adams materiality guidelines. That is not necessarily the guidelines that I'm going to test you on, but it's a good example of how materiality should be considered in context of planning. Okay, so be familiar with that. On the determining and planning materiality, go back and look at the quantitative base versus the qualitative factors. Remember, quantitative base is basically determining what number are we going to use as our starting point. And so our default, remember, is 5% of income before taxes. So if I say, do we need to use something other than income before taxes? You need to be able to tell me what is the reason that we would use something other than income before taxes. Very obvious one, if it's a not-for-profit entity, probably using profit is not a good basis for evaluating a not-for-profit entity. Okay, there are other reasons as well, but you need to be able to understand that. And then qualitative factors, those are reasons that we might adjust that percentage. So we've already established our base. Qualitative factors tells us why might we adjust these factors. Now, keep in mind for most of these qualitative factors adjust downward. It's very rare that we adjust upward. Upward would imply less risk. Okay. Usually when we find a starting point, like 5% of pre-tax income, that is our highest maximum point, and then we'll make that number smaller if we identify more risk. Can it happen that you can adjust it to a higher percentage? Conceivably, yes, but it's rare that happens. Okay. Chapter 4. So we had 4 different components of the audit risk model: audit risk, inherent risk, control risk, detection risk. Which of these does the auditor have control over? Detection risk, because audit risk is effectively a constant. Inherent risk and control risk are functions of the entity and their environment. We're the only ones who have to make a decision on detection risk, and that's what we control. That actually determines the scope of our testing. So what's the relationship between inherent risk, control risk, and detection risk? This is really important, by the way. This is the crux of the audit risk model. So remember, inherent risk is established once we actually determine the nature of the business the organization's in. They should actually know that there are risks in their operations, so they're going to implement controls. We're going to evaluate how effective these controls are in place, whether they are designed effectively and operating effectively, and we're going to determine what do we believe remaining risk is. That's going to result in risk of material misstatement. Remember, risk of material misstatement has an inverse relationship to detection risk, okay? So if I say high risk of material misstatement, then what does that mean about risk of material misstatement? Low. Do we like low detection risk? No, remember, detection risk is our appetite for risk, okay? It sounds like when we say low detection risk, like, yeah, good, low risk, But remember, detection risk is opposite. It's a weird one, okay? It's an appetite for risk. If we have low detection risk, that means we've got a lot of work to do. Conversely, if I say low risk material misstatement, detection risk is going to be high, and that's a good thing. That means we have a high appetite for risk. It means less work to do during substantive procedures. All right. During risk assessment, we talked about 4 different types of procedures that can be performed and 4 types of evidence that can be collected. So remember, 3 of these can be collected during any phase of the audit: inspection of records and documents, observation, inquiry. Also, we have analytic procedures. Specifically, what type of analytic procedures do we perform during risk assessment? So there are 3 adjectives I'm going to use: preliminary, substantive, or analytical. Which ones do you use during planning? Preliminary, yeah, preliminary. Okay, we'll talk about the other 2 here in just a second. All right. Fraudulent financial reporting. We talked about 2 types of that. What are they? So misappropriation of assets or theft. And then, sorry, I should talk to misappropriation of fraudulent financial reporting. So we talked about 2 types. Fraudulent, yeah, they're listed there. My bad. I meant to say fraud. What are the 2 types? Fraudulent financial reporting and misappropriation of assets with theft. You'll have to apologize. I'll have to apologize to you guys. I'm getting old. Okay. So what are we talking about when we say that? Fraudulent financial reporting is a misrepresentation of financial position portrayed by the client. Misappropriation of assets is just theft of assets. Okay, that's all there is to it. I promise I'll be better in the future. Okay. Difference between factual, judgmental, and projected misstatements. We talked about some examples of this. There was a slide that talked about that. If you don't remember that slide, go back and review that slide. If you don't remember the discussion, go back to the video and watch that, okay? Because I've asked questions about that consistently. You do need to understand the difference between a factual misstatement and a judgmental misstatement and a projected misstatement, okay? And I gave examples of all 3. The conditions indicative of fraud. So these are going to be fraud risk factors. When I use the term fraud risk factors, I am talking about specifically the fraud triangle. All 3 conditions have to be present for fraud to occur. There's going to be incentive or pressure, opportunity, and attitude or rationalization. I usually just say pressure, opportunity, rationalization. Okay. Just like the fire triangle. If we eliminate a heat source, fire cannot occur. That's the one we have control over when we're out in the woods. Okay. We eliminate that heat to make sure the fire is completely out. What's the one that we can control as auditors, that have most control over as auditors in the fraud triangle? Opportunity. Yes, we eliminate opportunity, fraud cannot occur. All right. Communication misstatements or fraud. We usually report to the audit committee, especially in the material that fraud that has direct and material effect on the financial statements. We also report any frauds that occur to the next level of management. So if something is occurring to the line, we're going to report to the line manager. Okay. If something is occurring at the highest level of executives, we're going to report to the executive manager. What if executive management, the highest level of organization, the highest managers, the CEO, the CFO, are the ones conducting the fraud? Are we going to report it to them? Say, you're conducting a fraud. You should know about this. That would be silly. Who do we talk to? Audit committee. Report to the audit committee. Okay. Report to the audit committee. Chapter 5, the most important chapter in the course. This is the one that you should probably spend the most amount of your time. Well, not the most amount of your time, the most relevant, relatively speaking. You should spend more time on chapter 5 than any other chapter because it's got the most content that's going to be relevant to this exam. So the categories assertions, make sure you know both. Make sure you know the distribution assertions. The concepts of audit evidence, please make sure you review that because we went through so much information. These concepts right here, the concepts that are listed here, tend to get thrown to the side. Will I ask you critical detailed questions in this area? No. Will I ask you questions in this area? Possibly. Okay, so make sure you spend some time reviewing that. We talked a minute ago about the phases in audit testing. Okay, remember we talked about the phases in audit testing. That has to do with the type of evidence we can collect. Okay, so let's go ahead. We're going to come back to this here in just a second. There are, relatively speaking, 8 types of evidence, though it's 10 because we can't vouching and tracing independently. Vouching and tracing are just fancy forms of inspection records and documents. What do you need to know for this? Remember our chapter 5 discussion where we all broke down and I said, okay, what is it? What are the assertions that it tests? What are the reliability? What phase of the audit can be used? That's it. That's what you need to know, which is a lot, okay? Because there's 10 different types of evidence. Trust me when I say some of these are easier than others. You will pick up on some of them very, very quickly, okay? So make sure you are familiar with each of these and go through those and drill them pretty really closely because I will ask you detailed questions in these areas, okay? There's kind of a spoiler guide here. What this guide right up here doesn't tell you is it doesn't tell you what phases of the audit can this be used. So let's go through these again, okay? So 4 types of evidence can be used during risk assessment. 3 of them you should know right off the top of your head. What are they? Inspection of records and documents, observation, inquiry. Good. What was the 4th again? Preliminary analytical procedures. Okay. Then we have our test of controls, which we got our 3 that are used in every phase of the audit: inspection, records and documents, observation, inquiry. There's a 4th one that can be used during multiple phases, but is almost exclusive to test of controls. Which one is it? One of the re's. Got a 50-50 chance. Recalculation or reperformance? Reperformance. It's reperformance. Okay. Reperformance can be used during substantive procedures, but usually about 99% of the time is used as a test of control. There was also a 5th one that's not in this list up here that I said you need to know it, but it's not representative of one of the types of tests we talked about. What was that called? It's a walkthrough. Okay. Why is a walkthrough not on the list? Because a walkthrough is just basically a combination of all the other types of tests. It's a fancy word. We're going to have a much more better definition in chapter 6, but do remember walkthroughs or test of controls. Then substantive procedures. We can perform what types of tests during substantive analytical procedure? Analytical procedure, okay? All the remaining tests we can perform during test of details. So we can use all of our tests during substantive procedures. So that's the breakdown. There's a lot of information there, a lot to organize and suss through. You should spend a lot of time on this because knowing this will will do well for you on the exam, because there will definitely be questions in this area. 100% chance. Yes. Yes. Inspection records and documents, observation, inquiry, and preliminary analytical procedures. And if you want a good refresher, if you wanted just a quick refresher, we had like a 15-minute debrief at the end of class. So you can go back and watch that video. Everybody had different items. Largely it was correct. Everybody did a really good job. There were a few corrections I had to make, but for the most part, everybody was spot on. So that would be a good refresher and debrief. Also refer to that spreadsheet that I posted on Brightspace that talks about all the information is listed here. This is not very pleasing to the eyes, but I put colors in the spreadsheet, so it might be a little bit more helpful so you can memorize that. All right. Okay. Remember, our ultimate goal at the end of the audit is to gain enough assurance to support our opinion. So whatever opinion we render, we should have enough information that we can say we are assured that our opinion is materially correct. Okay, we're trying to get to that final result. So the idea behind that, the filling the assurance bucket, is getting enough assurance at every phase of the audit that you get to 100%. I also gave my analogy, which I prefer, it's Chipotle burrito, because obviously I'm me and I like food. Okay, so that's going to be why I use that. Keep in mind that both analogies represent the same ideas, that we're trying to get enough assurance to support our opinion. That's ultimately our goal. All right, documentation. Remember, we had terms for documentation. We talked about work papers. So one of the most important things I think was relevant to documentation. So please make sure you know the three principles functions of documentation. So support, aid, and review. Okay, those are the 3 keywords: so supporting the audit report, aid in planning, performance, supervision of the audit, and providing the basis for audit review. So make sure you remember those. Probably the most important question in this area is going to be, what if these 3 items that are formatted documentation? Okay, so a heading. All documentation has to have a proper heading so we know what it is. At the top, it should say client, should say what the work paper is, what it's supposed to be doing, and have the balance sheet date, the testing date. Also remember, as part of the heading, it should include initials of who performed the procedures, when they did it, as well as who reviewed the procedures and when they performed the review. So a lot goes into the heading. All those are elements that are important to remember. Then we have indexing and cross-referencing. Indexing is basically that page reference at the top. It looks like it's basically a page number, okay? Tells you where it goes into the work papers. Cross-referencing is where we actually refer to items that are in the work papers together. So remember, we start out the work papers with the trial balance. All of our testing should be referenced according to what the items in the trial balance are, because ultimately that's what we're trying to prove. So if I've got a line item for inventory and say inventory is page A1, and then I go and look and say, I want to look at page A6 because that's my inventory testing, I should see a line item on page A1 next to my inventory amount saying refer to A6. And then when I go to A6, it should have the balance of inventory and it should say I got this balance from A1. That is a cross-reference. They refer back to each other. We will see that multiple times through our documentation. Then tick marks. Tick marks is just fancy term for shorthand notation when you perform a repetitive task over and over again. We'll see examples of that as well. All right. Analytical procedures. So make sure you know the different types of analytical procedures. Make sure you also know what phases of the audit that can be used in. I'm also going to throw in there that we talked about one that was not used during phase of testing. It's like a final analytical procedure. Basically, that's used during closing work to make sure that the financial numbers are consistent with our expectations as auditors. Okay. So 3 types of analytical procedures: preliminary, substantive, and final. By the way, only 2 of those are required by PCOB and ASB guidelines. There are only 2 of them are required by those standards. Does anybody remember which 2 are required? So the required ones are preliminary analytical procedures and final analytical procedures. Substantive analytical procedures are not required. They're generally just a good idea. All right. Very important. Be able to prepare an analytical procedure similar to the one that we worked through in class. This will not be a difficult task, but I will caution you. I may use an analytical procedure that's not identical to one that we used in class, okay? Identical in format. There are a lot of different areas in accounting that we can use analytical procedures. I may throw something at you. Trust me when I say that even if it's not something we've done in this class, it will be something that you've done in accounting education before. So don't panic and just make sure that you understand what it is I'm asking for. I don't think it'll be particularly difficult. I've used similar questions in the past. And I just want to make sure that everybody understands that there's a possibility that I could ask about something that we haven't explicitly done in class, but you should be able to do easily based on prior experience. Make sure you understand the decision process for substantive analytical procedures. What's always the term that we say whenever I ask you a question? What's always the correct accounting answer? Depends. What do analytical procedures, especially estimate models, depend on here in this class? What is the term for analytical procedures that we use in our evaluation? When we're developing a model, we always calculate a tolerable difference, okay? That is what it depends on. We have to make sure we calculate that tolerable difference and use that as our comparison point. And then additional stuff, obviously make sure you go refer back to some of the things that we worked on. I would definitely make sure you review these EUWC items. Anything that we talked about as discussion or part of homework. The EWC items are very good representations of how this all works within a documentation format. So I would take a look at those and make sure you prepare those in studying. All right. Questions on the study guide that I did not cover? Or questions that I did cover that you want more information about? Answers to the exam. Do you always want those? You have them in your brains. That's what you got. That's what I'm going to tell you. What a cheap shot. What a cheap shot. Yeah. All right. I can give you answers to the practice exam though. So what do we talk about that? Okay. Listed below are 4 types of opinions that can be issued in a public company accounting oversight board PCOB audit reports. Which of these opinions are referred to by a different term for ASB audit report? So that was our clean opinion, which is going to be the unqualified opinion. And remember, it's called unmodified. Okay, it's called unmodified. That's the term we use. All right. What is the name for the set of rules created by the AICPA that details the ethical and professional responsibilities for public accountants and in particular auditors? So special set of rules that was specifically talked about in chapter 2 on the very last slide of content that we talked about. That is the Code of Professional Conduct, which we're going to go into a lot more detail for. But again, make sure you review those slides in that area because there's some important content, even though we didn't spend a lot of time on it. Which of the following tasks should an auditor complete as part of the determination of whether to accept a prospective client for an audit engagement? This is an example of one of those ones about making sure you know what phase of the audit we are in. Okay, so let's go through each answer and think about the phase of the audit. Okay, document the necessary scope of substantive testing. What do you need to complete in order to determine how much substantive testing you have to perform? You need to complete test of controls because you have to identify control risk. Okay, so this does not occur until well after planning phase, because we're in planning phase right now is kind of the question that's going to be saying. We're talking very early planning phase about whether to accept clients. We don't have this information yet, so we can't obviously do A. Evaluate the operating effectiveness of the client's internal controls. That sounds like we're testing controls right there. We're not quite to that point yet. Make certain inquiries of the client's predecessor auditor. So before we actually go and do anything for the client, we go and talk to their previous auditor and say, hey, we'd like to know some things. That sure sounds like a planning step to me. And that's going to be our correct answer. But let's talk about D. Request that the client's legal counsel provide information about any unreported contingent liabilities the attorney is aware of. I realize that I wrote that sentence badly, but yeah, regardless of that, that is not something we do in planning. We do that in the very end of the audit. Consider the items listed below. Which of these items are factors that the external auditor must evaluate when assessing the reliability of the internal audit function? This relates to the idea that external auditors can use the work of internal auditors. We're going to be very fortunate that we're going to have some internal auditors visit us here in a few weeks that are going to talk about their responsibilities. So we want to make sure that if we use their work, that we can rely on their work to be effective. There are 3 criteria that I actually listed out for you. Okay. What's one of those? Competence, yeah, competence. So one is correct. What's another one? Objectivity, and those are the 2 that are listed up there. So 1 and 3 is the answer, which is B. There's a third one that's not listed here. Which one is it? Systematic and disciplined approach. Very good. Which of the following statements regarding audit committees is correct? All right. So what I like to do for questions like this is I like to go through the answers and see which part of the answers is incorrect. What makes a statement incorrect and which one's correct? An audit committee is comprised of a subset of all the entity's shareholders and creditors. Is that correct? No, okay. It is a subset of the entity's shareholders, which is called the board of directors, a subset of the board of directors. So, but not all creditors. An audit committee for a publicly traded company that is subject to regulation under SOX must be comprised entirely of financial experts. No, how many financial experts they need? 1, at least 1. Okay. Audit committee for a publicly traded company is subject to regulation or SOX must contain at least 1 member of the company's management. Is that correct? No, that contains 0 members of company management. They have to be outside and independent board members. There are no specific composition requirements for audit committees of privately held companies. That's hopefully a correct statement because the other 3 are incorrect. So yeah, D is correct. There are no requirements for publicly traded companies. As a general rule, an auditor calculates planning materiality at 5% of pre-tax income for its audit clients. Which of the following situations might the auditor use an amount other than pre-tax income as its basis for planning materiality? So this is asking when might we use a different quantitative basis? Okay. What might actually change our decision from using pre-tax income to some other basis? So the client is a privately held profit-oriented company. So does the privately held make any difference? No, as long as they're for profit, using profit as profit or pre-tax income is going to be a good idea. So this would be something if we thought that we need to change the basis to something that profitability was going to be relevant, but we're already using profit as our basis, so A is not going to be relevant. Client operates in a mostly unregulated industry. Now, would this affect materiality? Yes, but this is a qualitative factor. This is something where we establish our basis and then we adjust the percentage based on factors like this. So this is going to be a qualitative factor. Clients had material misstatements in prior years. Okay. Same thing. It's a qualitative factor. It's going to be one that we would adjust the percentage. So we've got the client is a financial services firm or mutual fund. This is one of the examples where we say we were going to use a basis other than pre-tax income. Why? Because it's an asset-based entity. Assets kind of drive their operations, so it makes more sense to use assets as the basis for materiality. So D is our answer. An auditor may be exposed to financial loss or damages to the professional reputation from litigation, adverse publicity, or other events arising in connection with audit financial statements. What's the term for this type of risk? Anybody remember our discussion? We talked a little bit about this. I said that there was a company that was a hub for adult content, and I said that Grant Thornton was no longer going to do business with them. What was engagement risk? That was the concept that we were talking about in there. Okay, engagement risk. Very good. Okay. Cressy's hypothesis, it's listed there, and the underlying part says they're aware this problem can be secretly resolved by a violation of position of financial trust. Which fraud risk factor best represents the underlying text? So remember, we have 3 fraud risk factors: pressure, opportunity, rationalization. Which one is what the underlying text represent? It's opportunity. Opportunity. Oops. Yeah. It's opportunity. So rationalization is are able to apply their own conduct in the situation of verbalizations and able to adjust the conception of themselves as trusted persons. So it's a little bit after that. So it actually, just as a hint here for the Cressy hypothesis, it actually goes pressure, opportunity, rationalization. So if you think of that sequence of terms, it actually talks about that. Okay. An auditor decides to test a sample of client sales transactions to ensure that sales were recorded in the proper period. Which management assertion is the auditor testing? So it's a recording assertion, but it's not just recording full stop. If I said recording full stop, what would we be talking about? Completeness. If I said recorded at the proper amount, what would that be? Valuation. Okay, valuation, allocation, accuracy. This is recorded in the proper period. What assertion are we talking about? Cutoff. Very good. Very good. Prior to testing the client's property, plant, equipment, an auditor determines it should verify management assertion of existence occurrence related to the fixed assets are required for a past year. By the way, I will try to use, I will frequently use, it won't always be the case, but I'll frequently use both terms. Technically speaking, this would be verified management assertion of occurrence is way you'd see this in language vernacular. If you see existence or occurrence or a combination of both, you should think existence occurrence. That's the assertion they're talking about. There's no difference in the language being used. Which type of audit procedure would provide the most reliable evidence related to this assertion? Okay, so analytical procedures. So analytical procedures, are they highly reliable? They're kind of medium reliability, but what's the main problem with analytical procedures? Do they test existence occurrence? They do not. They test VAA and comp. Okay. Inspection records and documents. Okay. Can they test existence occurrence? Yeah, we have a specific test for it. We've got vouching. But what's the reliability of inspection records and documents? Medium. Okay. So we're going to hold judgment. Okay. That's a possibility, but may not be not. Inspection of tangible assets. Is that a highly reliable test? Does it test existence occurrence? It does. That's probably our answer. Okay. Recalculation. Is that a highly reliable test? Does it test existence occurrence? No, it only tests one assertion. Does anybody remember which one it is? VAA, very good. VAA, very good. Yes. You can expect questions like this on the exam. I love asking questions like this, okay? The intermingling of reliability, types of evidence, phases of the audit when they can be used, and the assertions they test. 100% there's going to be questions like that. And when I say questions, you can expect more than one, okay? Consider the phase of audit and the audit testing below. Auditor decides to send confirmations to a sample of client vendors in order to test the reported balance for accounts payable, during which, I've got that typo in there and I've never gotten rid of it. Which phases of the audit is the auditor most likely to conduct this testing? Okay, so this one's basically saying, which phase of the audit can we use confirmations, okay? Do we use confirmations during risk assessment? No, risk assessment is inspection records and documents, observation, inquiry, and preliminary analytical procedures. Do we use it during substantive procedures? Yes, confirmations can be used during substantive procedures because all types of evidence can be collected during substantive procedures. Here's the gold star question for everyone. Can we use confirmations as test of controls? Okay, if anybody needs to run outside and yell yes, do it really quickly, okay? Inside this classroom, the answer is always no, okay? The answer is always no. So this is going to be substantive procedures only, which gives us D, 3 only, okay? You see, this always comes up, and I told you, never, 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 never. Okay. Just comes up on the exam, and I see you pick up your exam and go right onto the exam outside the door. I'll know that you got that question because you're trying to answer yes, but it's just fighting against you. Okay. By the way, you're not allowed to leave the classroom during the next exam, unless you have to use the restroom, but you can't take your exam with you. Okay. All right. Sally Seidel, CPA, is bringing analytical development expectation of previous year's sales revenue for a client, the BAPAC. By the way, Sally Seidel is my mom, okay? Her name is Sally. Her last name isn't Seidel, but she's like a big fan of crime dramas, so I always call her Sally Seidel, because in CSI, there was a character named Sarah Seidel. So anyway, that's the joke. She actually does work part-time at the BAPAC. She's retired. She volunteers, okay? So it has 2,400 seats equally divided between 3 sections, okay? The price per seat's listed, the percentage of seats sold is listed. They had 10 shows last year. What would be the expectation of BAPAC sales revenue? This should have been a pretty straightforward question for you all. So all you had to do is take the price per seat, multiply it times the proportion of number of seats. So divide it equally between 3 sections. 2,400 divided by 3 is 800. 800 times 100%, that's 800. So 80 times 800 is 64,000. 40 times 80% times 800 seats is 25,600. And then 25 times 60% times 800 seats is 12,000. That gives us $101,600 per show. Then you multiply it times 10, you got $1,016,000 D. All right, so working for the Audit Assurance Service Group, Amos Shania Ison Otero. I can't believe I said the forbidden one's name. I'm sorry. It's an old practice exam. Okay. You meet with a new associate named Ryan Jackson. Okay. By the way, if anybody's curious, by the way, Dr. Caden's husband's named Ryan. Her oldest son is named Jackson. Okay, that's where the names come from. So intelligent, hardworking, but he prioritized learning about taxation during college. I can't imagine why. Okay, didn't really learn much of the auditing course. Doesn't remember to call it the fundamentals, so you're going to teach him. All right, so identify and briefly define each of the four components of the audit risk model. Starts with audit risk. Okay, remember, audit risk is defined the risk the auditor expresses an inappropriate audit opinion on materially misstated financial statements. So we say the financial statements are fine, when in fact they are not. Now, I will not ask this question on the exam, but remember the scientific errors. We have type 1 error, type 2 error. Which one is audit risk, type 1 or type 2? Audit risk is type 2 error. Okay, type 1 error is saying there's a problem when there's not a problem. Type 2 error is when saying there's not a problem when in fact there is a problem. Okay, so I don't know if that's helpful or not, but I always just kind of partition that, saying that there's no problem when there is in fact a problem. Inherent risk. How do we define inherent risk? In this course, we can just basically say the fundamental risk of an entity's operations. The moment you start business, you're exposed to risk. Okay, those are inherent risks. For most of our organizations we're dealing with, they have very large inherent risks. So they're very large and dynamic. Okay. Then we have control risk. Okay, controls are responses to risk, but controls themselves can be problematic if they're not effective. What are the ways that it can be not effective? They can fail to be present. Okay, that's a deficiency in design, and they can fail to operate effectively, deficiency in operation. But effectively, risks that are still present after the entity takes action to address its inherent risk. If you answer this one saying risks that are still remain because the controls are not effective, that would be fine too. Something in that ballpark is basically saying we still have risks that the controls did not address. Okay. That leads us to detection risk. Okay, detection risk, that's where the auditor steps in, and that's basically where any remaining risk after planned audit procedures. So we as auditors evaluate risks in the other areas. We say, all right, we have to mitigate any remaining risks to an acceptable level. We're going to design our audit procedures to do such a thing. If we think the controls are strong in a certain area, then we may have to do less work. If we think controls are weak in another area, we may have to do more work. But detection risk is going to vary based on our identification of what happened with inherent risk and control risk. Okay, so those are the fundamental definitions, the basic definitions. I have to be careful. I tend to use that word fundamental way too often, and it was really, really awkward. You can ask Emily about this one day. I actually had an advanced AIS class where I could not stop using that word. It was just ingrained in my head. It was the weirdest day. And so, yeah, anyway, all right, memories. So let's go ahead and go through some examples here, okay? For each of the scenarios below, identify which component of the audit risk model the most closely relate to. CapCorp has inadequate supervision and other review of over petty or inadequate supervision or review over petty cash transactions. What type of risk is this? Which one of the four? It's control risk. Yes, is an example of inadequate authorizations, which would probably be an issue with respect to segregation of duties. Audit engagement for Rosen did not conform. Rosen Corporation did not perform confirmation testing of Rosen's receivables. As a result, the auditor failed to identify a material misstatement of accounts receivable. What do we got here? It's detection risk. Okay, we did not construct our procedures effectively to identify the necessary mistake or identify this misstatement that existed. Because this business model requires that it carries large quantity of inventory, E&L enterprises are susceptible to theft. By the way, that's Emily and Lauren Enterprises, in case you wanted to know. Yeah. Anyway, what's susceptible to theft? What is that? It's inherent risk, okay? The business model by design basically says that this is one of the risks they're subject to, so that's one thing they have to be aware of. Halter Technologies operates in an industry that's highly competitive and subject to rapid change. What do we got here? This is also inherent risk. Okay, it's a description of the industry where they operate in. Although the audit engagement team for the Go Corporation was not able to obtain sufficient appropriate evidence to justify its conclusions, the auditor issued an unqualified audit opinion. Not a lot of room for interpretation on this one. This one's pretty straightforward. Which one is it? That's audit risk. Okay, that's by definition audit risk. They basically said things are fine when things are fact not fine. All right. Moving on to the next part. Which two components of the audit risk model comprise risk of material misstatement? Which ones are there? The two of them out of four. Inherent risk and control risk. Yes, very good. Okay, whole risk. What's unique about inherent risk and control risk with respect to the audit risk model? They are functions of the entity and its environment. The auditor has no control over those. Can we reassess them if we believe that our assessment is incorrect? Yes. Can we go and change inherent risk and control risk? No, okay. We do not exert the ability to change inherent risk or control risk. That's not our goal. Our goal is to assess them as accurately as possible. Now we can change our assessment, but we cannot change the risks themselves. Which component of the audit risk model is the only one the auditor has control over? Okay, so we had inherent risk and control risk in the previous question. This one's obviously got to be detection risk, okay, detection risk. To briefly explain the relationship between this component and the scope of testing the auditor must perform as a part of substantive testing. If you wanted to do a comprehensive answer to this question, you would start with test of controls, okay? Basically, you assess inherent risk and then you test your controls. Then you establish what control risk is. This gives you a determination for risk and material misstatement. That is our starting point for detection risk. Why? Because remember, risk and material misstatement is inversely related to detection risk. If I determine that risk and material misstatement in an area of the audit is high, my detection risk is going to be low. Yeah, that's the word I was looking for. It's going to be low, okay? When detection risk is low, that means we can only tolerate a very minute amount of risk. So we move on to substantive procedures. And if we can't tolerate much risk in substantive procedures, what does that mean about the work that we have to do? There's a lot of it, okay? So the way you should think about it, okay? Test of controls result in risk and material misstatement that is high. Detection risk becomes low. Substantive procedure work is high. Let's flip it around. We finish our test of controls. Even though inherent risk is high, the controls are great, okay? So control risk is low. Risk and material misstatement is thereby going to be low, okay? If risk and material misstatement is low, our detection risk is high, okay? If detection risk is high, then our work that we have to do subsequently, our substantive procedures, is going to be low. We don't have to do as much work. Now, I want to clarify because I may not have done a good job because we did a lot of work back in chapter 4 and chapter 5. Keep in mind when I'm talking about the assessment of controls and risk and material misstatement and all that, it is specific to an area of testing. Is it possible that you could have really, really good controls over inventory, but bad controls over cash? Yes, okay. So it's going to be unique to every process area or every area that we test in, okay? So keep that in mind. It's probably not going to come up on the exam, but I do want you to start thinking about it that way. We're not assessing controls for the entire audit. We're assessing controls for whatever area it is we're testing for a given particular series of tests. That does it. Are there any questions? Anything on the exam that you need me to cover again? Yes.
I walked in slowly. What was the questions for each chapter?
So there's going to be one question on chapters 1 and 2 each. These are multiple choice questions. 4 questions on chapter 3. And the 3 questions each on chapters 4 and 5. And the problem will be over all chapters, but we'll primarily focus on chapters 4 and 5. Anything else? Yes.
You still have a major phase of the audit, yeah.
Sure. The major phases of the audit are going to be planning, risk assessment, test of controls, substantive procedures, which includes analytical procedures and test of details, closing, and reporting, I should say. The ones that you're going to primarily be focused on are the ones where we actually gather evidence, which are going to be risk assessment, test of controls, and substantive procedures. Because we're talking a lot about evidence gathering, but technically speaking, the whole entire phase of the audit is going to be broken out to a much bigger detail. Other questions? It's exactly 2 more questions than I've got from other students who have taken this course before. So yeah, group of overachievers. All right. I will have office hours tomorrow. If you need to come talk to me in office hours, I'll be there. If you want to reach out to me outside of office hours, I'm more than happy to help. Best of luck with your studies. See you all on Wednesday.